In an era defined by digital transactions and global interconnectedness, it's easy to overlook the fundamental mechanisms that power our world. But if you look closer, beyond the gleaming cityscapes and the constant hum of activity, you'll find two forces working in tandem, shaping our lives and our economies. These aren't new inventions, but their modern form is more critical than ever. We're talking about debt and credit, the essential gears that drive the engine of the modern economy. Debt is a word that often carries a heavy weight, but it's fundamentally a two-sided coin. Think of it as a tool. In the right hands, it can build empires. We see it in the mortgage that turns a family's dream of a home into a reality, the business loan that allows a startup to innovate and grow, or the government bond that finances new infrastructure like bridges and hospitals. This is often called good debt, an investment that generates future value. On the flip side, bad debt, like high-interest credit card balances used for non-essential luxuries, can create a cycle of financial strain. From the individual consumer to the largest corporations and even national governments, debt is used to finance operations, manage cash flow, and fund growth. But it always comes with the inherent risk of over-leverage if not managed wisely. If debt is the tool, credit is the trust that allows us to wield it. Credit is, at its core, a measure of reliability. It's the belief that a promise to pay will be honored. This trust is quantified into a credit score, a simple number that tells a powerful story about your financial history. Lenders use this score to determine your creditworthiness, influencing everything from your ability to get a car loan to the interest rate you'll pay on a mortgage. For businesses, a strong credit profile unlocks access to capital, enabling them to expand, hire more people, and invest in new technology. Building good credit is like building a reputation. It requires time, consistency, and responsible behavior, but it opens doors to financial opportunities that would otherwise remain closed. The intricate dance between debt and credit is what fuels the dynamism of our modern economy. Picture a constant flow of capital. Individuals deposit savings into banks, which then lend that money to businesses seeking to expand or families looking to buy a home. This cycle, facilitated by credit, allows money to be put to productive use, driving economic growth. Central banks like the Federal Reserve play a crucial role by setting interest rates, which influences the cost of borrowing and helps manage the pace of economic activity. This complex interplay ensures that capital is allocated efficiently, allowing for everything from global trade and stock market investment to the simple convenience of a credit card transaction. However, this powerful system is not without its challenges. The very mechanisms that drive growth can also create vulnerabilities. When debt accumulates too quickly, it can lead to economic bubbles, where asset prices become unsustainably high. The bursting of such bubbles can trigger financial crises, as seen in 2008, with ripple effects felt across the globe. This highlights a critical truth. For the system to remain stable, we need more than just access to debt and credit. We need understanding. Financial literacy is the ultimate safeguard. By learning to manage debt responsibly and build credit wisely, we not only secure our own financial futures, but also contribute to a more resilient and prosperous global economy for generations to come.